Hey, how's it going? Friday, Zebu Live, we made it. Halfway through. Thanks so much everyone for coming. We've got the most exciting panel of the day, crypto taxes, so you can cheer at this point. We've got an awesome panel joining me today. For those of you who don't know me, I'm one of the co-founders of Zebu Live /Flight 3. So really appreciate the support for everyone coming down. 525 days of bear market. We're still here. We're still building. Anyone who here should cheer themselves because this is where you make the incremental gains. But let's jump into some introductions. We've got Ben next to me. We'll just go left to right. So here you go, Ben. Do you want to introduce yourself?
Hi, everyone. My name's Ben Lee. I work at a firm called Anderson. And I love tax. That's probably why I'm here on stage. I'm an accountant and a
Who
tax
doesn't?
Who doesn't? That's why we're all
Come
here.
on.
And why you're here as well. Possibly, maybe not. But yes, I'm an accountant and a tax advisor, and that's probably pretty much me, I think.
Thank you. Over to Louise.
Hi, I'm Louise Lane. Hello. Oh, that's very loud. Hi, I'm Louise Lane. I'm head of crypto at Wright Vigar. We're a traditional firm of accountants, but we've got a very large crypto team now that we've developed over the last 5 years. I'm a crypto tax and accounting specialist, and we look after crypto businesses and individuals. We work really closely with all the guys here with Crypto UK, trying to shape the new tax laws for the UK. And I think with that, I'll pass you over to Jamie.
Thank you. So my name is Jamie Nuttall, and I am a drummer for a Disney band. But in my spare time, I am the head of crypto tax for Miner, one of the leading crypto-only organizations in the UK. In terms of my background, what I do offer plenty of webinars, seminars, lectures to universities on all things crypto and taxation. I'm a fellow member of the ACCA, and I love Disney nearly as much as I love tax and crypto.
Hi everyone, my name's Dan. I'm co-founder and CEO of Recap. So we make privacy-focused crypto tax software. Our primary market is actually here in the UK. 90% of our customers are UK customers. And we're pretty involved in shaping tax policy here in the UK. So I also co-chair Crypto UK's working tax group, where we're looking to proactively change DeFi taxation. And we've probably given HMRC hundreds of pages of detail on DeFi, particularly around call for evidence responses and the consultations that they've got out there at the moment. So we're hoping we're going to get some change in the coming months that makes DeFi taxation easier. I'm really big in the space. I've been in the space for a while. I've been in the space since 2013, 2014. And I'm really excited about DeFi on Bitcoin. I think we've seen DeFi innovation primarily on the Ethereum blockchain. I'm excited to see what the next wave of DeFi is when we can get Bitcoin involved in those transactions.
100%. And if you haven't gone and checked out Stacks'
Stacks, yeah.
Stacks is kind of like the application layer for Bitcoin, so they're doing some awesome stuff. Definitely check them out. But let's jump into it. Let's let the fun begin. So, you know, it's a bear market, and there's a lot of different things happening. Some people had some losses. You know, what do people need to know? What do crypto investors need to know and consider in a bear market? Ben, over to you.
Yeah, sadly, just because we're in a bear market, the problem doesn't go away. Unfortunately, we can't bury our heads in the sands and just pretend that everything's okay. But there's certainly things that people could be doing proactively to help them with their taxes now. A lot of that is going to be around losses and what your portfolio might look like at this point in time. Now, I'm not a mind reader, but I'm guessing with the events of the last 12 months, what might have happened is it's probably not looking as good as it might have done at one point in time. Now, it's probably time for review. It's probably time to look at what's within that portfolio. You know, what tokens have you got? What NFTs have you got? We're speaking about different things today and different topics, so I don't want to step on others' shoes, so I'll sort of just give a bit of an overview. But there's certain things that you could do to actually crystallize those losses at this point in time. That might be actually looking at portfolio and going, these things aren't really working for me. When the next bull run comes along, you know, what is the value in this project? Is this project still viable? What's the noise coming from the founders or the marketing team? You know, where are we going? And obviously, once you sell those tokens, you crystallize a loss. You can use that loss against gains going forward. So come the next bull run, if you're making gains with other tokens or other assets within your portfolio, you can offset those losses. Now, another aspect is what we call negligible value. Negligible value, it's hard to say, negligible value claim is something that you can effectively do on your tax return to say, hey, I've got some assets. They were worth something once, but now, guess it, I've already given the punchline away, they might have negligible value. They're not worth a lot. Now, what you can do is on your tax return, you can go, hey, look, I don't think these have any value, so I'm going to put this in. And effectively, what happens at that point in time is you're deemed to have just sold them and reacquired them for the value that they might be now. Now, with crypto, it's quite interesting, and whilst I don't want to hog the mic, this can bring up some really interesting aspects. Certainly where you might have had assets on exchanges that are no longer around today, or perhaps going through bankruptcy proceedings, or even more centralized DeFi platforms, CeFi platforms, that might also find themselves in difficult positions and also going through claim processes. Now, unfortunately, all is not lost, he says, tentatively, with these platforms, but it does raise some interesting, and I say the word interesting, sorry, like tax interesting. This is the kind of thing we find interesting that probably isn't interesting to anyone else. But there are certain things that we need to consider. If we look at, say, FTX, if I held assets on FTX and I can no longer get to those assets, what can I do about that? I might have significant value that was locked up there. Can I write that off for tax purposes? What is my position? Now, we in the UK have a lot of rules that apply to how we determine the cost of an asset when we sell it. Now, these rules are primarily made for stocks and shares, and it pulls all stocks and shares together. And if you think, well, if I've got shares in a company and that company goes under, likely all those shares don't have any value. Happy days, I can do that negligible value claim. Unfortunately, because we kind of put digital assets in the same group, it then raises an interesting point around, well, not all my assets have been depleted. So if I've got 2 Bitcoin on FTX, but I've got 5 Bitcoin in a non-custodial wallet, I haven't actually lost all the value across that asset base. Can I still do a negligible value claim for what's on FTX? That's something I would suggest you talk to a tax advisor about. But these are things that we are all trying to effectively look at within the industry. Let's say Celsius, for example, is another good example. And other platforms where you could put your assets on to this platform for loans, rewards, etc. We have to think, right, when have you lost your assets? Interestingly, with Celsius, I think it was around about sort of terms and conditions number 8, they actually described it not as a loan, but actually a sale and repurchase of your assets. They actually said, these are your assets, so have you made a disposal at that point in time? Is what you have actually a right to receive assets? You don't actually have your Bitcoin anymore. You've got a right to receive that Bitcoin back from them. Then we need to take into account what the bankruptcy claim might be. So you might be sitting here thinking, oh, this is all this is happening to me, and this isn't great, and how do I maximize a tax position? And you might have disposed of those assets much earlier than you thought you might have done. I'm not really cheering the room up. I'm really sorry. This is the vibe I'm getting.
It's not looking good.
It's not. I'm going to have to pass over to someone else in a minute to just bring everyone back up again.
You're supposed to be the cheery one.
I know, it's failing. I'm bringing everyone's out.
I'm bringing doom and gloom.
The preparation did not go to plan.
It's not, has it? Sorry, everyone. But so what am I trying to say here? It's really have a look at what you're doing, and these my esteemed colleagues sitting up here will also share their insights into how you can make the best of a bad situation. But it's all about, okay, making what you can out of what you have now, what you think the next 12 months might look like, and making sure, don't let the tax tail wag the dog, but is there anything that you can do to maximize the best out of your position? And I've been talking for far too long, so I'm going to give it to somebody else.
Awesome. Does anyone else have any thoughts?
Yeah, so just going off on that with negligible value claims and whatnot. Now, this situation might not present itself to a lot of people in some situations, and that's fine. There's other things we can do proactively. So Ben has outlined this quite nicely with negligible value claims being a hindsight tax planning opportunity. Fantastic. But we are coming up towards the end of the tax year in February, March time. So what can we do in advance of the year end? Well, during a bear market, what we can do is start to look at the actual market value of certain assets that you hold, be it NFTs or cryptocurrencies and tokens and coins itself, and think, right, could I do something that is called tax loss harvest? So tax loss harvesting, I think the Americans call it wash trading or something like that. And what this means is where you've purchased an asset, say, for £10,000 in fiat, in terms of value, and it's plummeted because of the bear market, and it's not quite gone all the way down to zero for negligible value claims, but it's worth about £1,000. So you can't make a negligible value claim because it is not of negligible value. So how can you crystallize these losses? Well, you dispose of the asset. So it's one of those things you can look at in advance to plan ahead, and it's very powerful because you might have some fantastic gains over here and end up paying a lot of taxes, but you go, actually, I've got all these uncrystallized losses that could actually offset that to the point where it could be very little, if not zero. So I would recommend for anyone, none of this is advice, by the way, you can't sue us, but I would recommend for anyone that sort of February, March time, have a look at your portfolio, if not sooner, maybe perhaps now, using someone like, I don't know, Recap, and just have a look and see, can you tax loss harvest there at all? Because for every single client that I spoke to, at least, I don't think there's a single one that turned around to me and said, Jamie, that was a waste of time. Every single one of them would that did look into it would benefit from it.
I've got another point on that as well. Take it one step further. So you might not want to give up on the asset. So you might think, yeah, it's worth a load of, not very much at the moment, but I don't want to give up on it. I think it might raise in value. So what you could do is actually sell it to your own limited company. You can set up a limited company as a crypto investment vehicle. You can then sell to that company. You sell it at market value automatically. Doesn't matter what you move it across at. It's automatically sale proceeds £1,000 in Nathan. Nathan? Who's Nathan?
Who's Nathan? How long have you known me for,
I know
Louise?
Jamie really well. I don't even know that many Nathans.
It's okay, Sarah.
So £1,000, you sell it for £1,000. We're expecting the purchase cost to be a lot higher. You've crystallised that loss personally, so you've got a nice loss to offset against your other personal gains. Then you carry that forward in the limited company. Yes, you don't have direct ownership of it, but you still control the company, and you've got yourself a nice investment portfolio in a limited, which can have its pitfalls, banking not the least of them, but no time to go there at this point in time. Please see us afterwards if you're thinking about that.
So I think what we're talking about here is silver linings in a bear market, right? The ability for you to offset losses, do some very crafty structuring. And you can't do any of that without having visibility. So it's quiet in the market. You might have stepped away from crypto. You might be not as proactive as what you were in the marketplace. But if you can be proactive with your crypto accounting, there's a massive opportunity to take advantage of offsetting losses moving forward, so you can set yourself up for the next bull run. We don't know when it's coming, but the opportunity is now to lock in those losses before the market rolls around again, which I'm sure it will.
Is it worth saying as well, you don't have to be in a self-assessment position to claim those losses. You can just do it by writing to HMRC and going, hey, look, this is what I've done. I mean, if you have done that, they might think, well, hang on a minute, you're claiming your losses now. Is there anything else we might need to look at? And maybe it's the time to get everything up to date to make use of those losses. But you don't have to be in the self-assessment system to claim those losses. And we are pro gains here, right? What we're trying to do here is when the bull market comes and everyone's just rolling in cash or digital assets, right? This is just trying to preempt the tax bill you may face at that point in time by making the most out of it now.
Yeah, I don't think preparations hurt anyone, so definitely tax is no different for that. I just want to pick up on something Jamie was talking about. Obviously, Recap's an amazing platform, but software and innovation in that sort of area is a big part of how we get crypto taxes moving forward. I know blockchain.com did a really cool integration with TurboTax, where it's automatically done for you. I was wondering if you could make some comments on where you think the next big catalyst, the next big events that are really going to help simplify crypto taxes for people.
Yeah, sure. So our ultimate goal at Recap is we want to empower you to get your crypto taxes sorted. Like, we don't want it to be a headache, and let's face it, it's a pretty big friction point in the industry. So, we want to give you that visibility so you can optimize your tax position, so you can look at your losses, and so you can act at the drop of a hat without, wading through your accounts year on year. That is the ultimate goal of Recap. But there's kind of a trade-off. If we kind of look at how we calculate crypto taxes, we need to see all of your data. We're cognizant to the fact that we literally need to know everything about you, every transaction you've ever made since you started in this market. And we actually think this information is so sensitive. If you imagine, you might have made your first transactions when there was no tax guidance. You might be making transactions today in the bleeding edge of DeFi, and there's no guidance. You may have filed, you may have not filed, right? So we're cognizant to the fact that we are a custodian for your data, and that data, if it gets into the wrong hands, basically unwinds and correlates your entire portfolio value. It correlates your tax position and could potentially be very compromising. So we think the theme of crypto tax moving forward, it has to have some kind of privacy focus or privacy trade-off. So the way we approach this at Recap is, we could say we're SOC 2 compliant, which basically means we have a lot of security standards within our tech stack, which means it's hard for your data to be leaked, right? But we actually don't think that's good enough for the industry. We're all here because we're involved in crypto. So what we do is we use end-to-end encryption. We encrypt all of your private financial data so we can guarantee that that data is only owned by you. So we're kind of the tool set. And our kind of motto at Recap is, we never want to see your data. And there's a few key themes that are happening at the moment. We're all involved in Crypto UK. We're all involved in proactive tax policy. And compliance is really heating up. I think it's safe to say that HMRC in the UK have been very much on the educational side. Like, you may have received a nudge letter from HMRC. That's not telling you that you have to file. It's telling you may need to file. It's all been very gentle. But the way the market is going, just to give a few examples, we have a change to the self-assessment tax return forms in, I think it's 2024, 2025. And there's now going to be explicit boxes in the capital gains tax section for crypto assets. For the first time, crypto assets actually mentioned on a tax filing form. So you can kind of see how HMRC are looking at the industry. They're looking at analytics. They want to understand who's filing and who isn't. Secondary to that, and it's a more wider point throughout just capital gains in general, there used to be a capital gains tax allowance of $2,300. So if you had a very modest portfolio, you knew you could make a couple of gains, a couple of grand worth in gains. You didn't have to think about tax. You didn't have to declare it on your tax return. You didn't have to use or leverage any crypto tax software. But now that net is getting much larger because they've reduced the capital gains tax allowances to £6,000. And next year it goes to £3,000. And this market is so volatile, so it's not unheard of for your assets to fly up in value. And if you time those trades wrong, you're going to be creating taxable events, which then require you to file. So I know this all sounds quite scary. But from a global perspective as well, the tax authorities know there's a tax gap. They know that this market is not going away. And the tax authorities are coming together to create global standards for crypto tax compliance. So there is a new framework coming out called CARF, which is called the Crypto Asset Reporting Framework. And that is an OECD-led initiative where if you are an exchange that's domiciled in any kind of major jurisdiction, they will have to report, if you've got a Bitcoin on account with them, they will have to tell the tax authority that you have a Bitcoin on account. So we're now getting to this analytics compliance phase, and we think privacy is key in managing all of this moving forward.
Can I add on to that very quickly? Sorry. It's really interesting. So you mentioned the tax gap there. The tax gap, for anyone who doesn't know, is the amount that effectively HMRC think they should get and the amount that they do collect. Does anybody in this room, or is anyone happy to hazard a guess what the current tax gap is here in the UK, the last published figure? Yeah. 35. Thank you for guessing, but yeah, 35 billion, right? Does anyone know what the tax gap is on crypto? Good, because nobody does. Nobody knows what that looks like, and this is the point.
Good job I didn't sit here nodding like, yeah. I was like, no, I don't actually.
Am I supposed to know this?
Yeah,
as well?
come on, Dan. No, but that's the point, right? So the point you've raised there, Dan, is really relevant. You know, we've got this calf coming in. It's shrinking that tax net, and once the calf, we've already got one called DAC 8. It's the only standard that's been agreed so far, which is again all about tax transparency, but has a slightly wider remit. Calf, if and when implemented, is going to be in over 100 different jurisdictions. And it's built off the back of a standard we already have called the Common Reporting Standard. Don't worry, I'm not going to talk anymore. I can probably see people falling asleep just at the mention of that. But that takes year-end information and reports it. CARF is going to be transactional data. It's not just a position, it's going to be all the transactions that have happened that are going to be released to the tax authorities, and that's really significant. So sorry, I just wanted to add that one to the end of.
No, I was just going to add on and say, do you think these sort of agencies and standards have been approached in a fair way, in the sense of how is crypto looked at it? You know, watching the Panorama, BBC Panorama on SBF, I thought it was an absolutely disgraceful sort of showing of what the knowledge of Web3 and crypto assets are out there. There's a lot of diligent traders, just like FX traders. I'm sure if there was a new scheme to make sure the FX tax gap was closed, it'd be approached in a very different way. So I was just wondering how you're sort of seeing those conversations going, how the consultations are going.
I've jumped in. No, go on.
So I would say, like from a UK perspective, you know, we engage with HMRC through Crypto UK. They see this as a market that is not going away, and that the UK has a significant future. You know, we are a leading financial centre. We are a crypto asset hub. I think they recognise that, and they want to remove a lot of the pain points that come with perhaps accounting for your crypto taxes or certain tax treatments for crypto taxes. So I'm actually quite positive to what's happening at a government level. I think the hardest thing is that, you know, if a tax authority decides they want to legislate to make things easier, they need ministerial buy-in, and that's where we have the educational difficulties. How do we tell MPs about crypto and what crypto is? If I talk to my MP about crypto, he'll have no idea what it is.
Just send them tickets to Zebu next year.
Can you arrange that?
Dr. Lisa Cameron is here. If you haven't already seen her speak today, she's the chairperson for digital assets in the UK and in UK Parliament. So check her speech out on YouTube. That was awesome. But yeah, I know that there's definitely an education gap of trying to get that across to people. So moving into the next topic is NFTs. It's the crazy tax maze that no one's managed to demystify, but we've got Jamie Nuttall here, so maybe we can have a shot at it. So over to you, Jamie.
Yeah, we'll try and do this in as few words as possible. Let's start at the very beginning with NFTs. I think there's a current total value of NFTs of around $22 billion with an expected value of $80 billion by 2025. So it's not a small proportion of the market whatsoever. So it's important to specify NFTs and really ring-fence that to itself. Now, with NFTs, the initial step I would recommend taking for most situations is to decipher which regime you're going to be under when it comes to your personal NFT portfolio or your project, for example. Are we talking income tax? Are we talking capital gains tax? Usually it's a bit of both, depending what's going on, because you might have airdrops, for example, under the income tax regime anyway. So the first thing you want to do is actually differentiate between the two. And we were discussing earlier on, is there a time when an NFT project, so you launch a project itself and you're running it, is there a time when that is not considered self-employment or a business or trade? I can't think of any time that would be the case. So you really do need to get to the nitty-gritties initially and understand what is going on with you. So as a firm, Miner, we own 2 mutant apes, part of the Bored Ape Yacht Club collection, which, has anyone not heard of that? This is what I'm saying. So That is clearly not our project. It's nothing. We're not going to be paying under the income tax regime if it were to be held personally, for example. So how do you decide? Now, there is something called the badges of trade for those non-accountants in here, where effectively it goes through a list of questions where you kind of say yes or no. It talks about the level of the trade in frequency, the profit motive, and it goes down this list. And you have to, when you look at these badges, you have to make sure you do it from a crypto investor perspective rather than a typical, I'm going to invest in shares or stocks or whatever it might be, because I have so many more transactions in my crypto portfolio than I would my shares and stock portfolio. So be careful of that. Once you go down this list of badges of trade, it should give you a good idea of whether it's income tax or it's under trading or not, therefore income tax or capital gains. Now, personally, I would always add one more question to the end when it comes to crypto. And that would be the level of sophistication involved with your particular case. So, for example, say you have some bots. That's pretty high level compared to, say, you over here, who you just buy a couple now and then, you keep it, you hold it, you might, hodl, you might sell it later on. You never know. So very different already, and that would seem, oh, maybe that's a bit more trade, possibly. But it's still going to be one of those now 10 questions. So personally, I look at the level of sophistication. Now with NFTs as well, and I know Ben has touched upon it before with negligible value claims, these you can still make those claims with NFTs. So don't think it's just for your tokens and coins. NFTs are still within that catchment area. In terms of how you do it and what to do, talk to us afterwards and engage with one of us as a client, and we might tell you. But the point is, it's there for you. I'm sure you can Google it. And to be honest, I've probably spoken about it online for free anyway. Just don't tell too many people.
Always dropping the alpha, Jamie.
So that's always good to know. The other thing with NFTs as well is the pooling rules, Section 104 pooling. Has anyone heard of Section 104 pooling? Excellent. I see accountant. My number 2 at the back there. Thank you for putting your hands up. I'd be worried if you didn't. So this is where you effectively, in I think America, they have first in, first out, or last in, last out, and we're a bit more familiar with that. We have a pooling mechanism with crypto. So say you buy crypto on day 1, day 30, day 155 to 5,000, whatever. It's all pooled together to create an average cost to sell. Now, NFTs are non-fungible. Non-fungible, which means they are each uniquely identified, unlike your Bitcoin and my Bitcoin. I do not have a Bitcoin. We can't tell the difference, whereas NFTs you can. So what does that mean for the pooling rules? Well, your Bored Ape and my Bored Ape, we wouldn't pool them together necessarily. However, and I know for a fact, Louise, you're going to jump in and tell me I'm wrong. I personally believe, and I've spoken to a few people at HMRC and some other people, that the 30-day window might still apply. So what this means is when you, I know you don't like
Charlie's going to get his fight that he wanted.
Yes.
He's like, he wanted some drama.
I'm thinking, am I going to come in on this as well? Yeah.
I'll take you all on. Let's go. No.
Positioning.
So what we're saying is, if you were to sell an asset and then buy it back within 30 days, usually you would pool them together, and it kind of negates the effect of potentially a huge gain or huge loss. Now, with the pooling rules for NFTs not applying as a collective sort of series of NFTs, it is not clear if it would still apply within 30 days. And the bottom line, genuinely, and serious talk here, is I don't think anyone really knows for definite. There is arguments for both sides that it doesn't apply at all. There's arguments for the other side that says it might apply or does apply. So I'm being a little bit more cautious around it all, if you can help it. But I'm sure these guys will jump in with that and say otherwise. So I'm just going to move on very quickly to ordinals. So ordinals, has anyone heard of ordinals? Yes, fantastic. Bitcoin-based NFTs. Something to keep in mind if you are involved with this. Sort of obviously next year you might want to get in touch with your tax advisors. Hopefully by then we would have figured them out. It should be fairly straightforward, but we were talking about how, because there are attached to Satoshis? Like, do the assets, do they separate? How does it work?
Yeah, I think the debate was, do we treat the NFTs as separate to what's happening on the actual Bitcoin blockchain? So you just treat the NFTs as like a layer 2. So you'd end up with a different accounting treatment for the actual Satoshis compared to the actual accounting treatment of the NFTs. But again, it's probably not clear, and we might get some guidance in the future on that.
Don't hold your breath.
DeFi then. So let's move on from that because it sounds too scary with the ordinals. But DeFi is a big one. That's decentralized finance for anyone who wanted to know. But there's a lot of discussion around staking and how that's the tax treatment is currently. Again, it's quite a new thing. So people are still trying to find out what the recommended guidance is. Louise, can you give us a bit of an update on where we are now and where you see it being in the future?
Yeah, sure. I could probably talk for 4 hours plus on this. It is so complex.
That's what we'd want. We tried to fit it in, but it's...
Please forgive me. This is going to be a really generic overview, and it might not be entirely suitable to your situation. The most important thing to mention is HMRC called this guidance for the tax position on DeFi. They're saying DeFi lending and staking. Please don't think that if you're doing it on a centralised exchange, you're outside of the scope. They've made lots of caveats to say this is DeFi-like activity, and it applies, equally to centralised, decentralised. The main thing we have to consider is what are the tax points. Like, when you're going into a DeFi position, you're locking up your tokens. So it could be staking, it could be lending, going into a liquidity pool, adding collateral. At the point you lock up your tokens in that DeFi position, is there a taxable event or not? Before HMRC released their guidance in February 22, we wouldn't have even dreamt of that being a taxable point. And it's a bit of a kicker that it is. We're trying to fix it, and hopefully we will in the future. But we've got these rules for a few years yet until we get some new laws in. So we do have to tackle it. We do have to think about it. So the tax position of the tokens that you put into the protocol, you need to know, did you keep beneficial ownership of those tokens whilst they were at someone else's disposal? And if the answer's, I don't remember which way I phrased the question. If you kept beneficial ownership, there's no problem, no drama. All you have to do is worry about when you get the reward and the yield in at the end, tax that, probably income, miscellaneous income, income tax, no national insurance. If you did lose beneficial ownership, it's pretty disastrous if your tokens are standing at a much higher value than when you acquired them. Let's say they're worth 50 grand at the time you go into the DeFi position, but you got them for 10. You've made a 40 grand capital gain. So, assuming you're in the capital gains regime as an investor. That's capital gains tax that's payable pretty soon. You might have those tokens locked up in the DeFi protocol for 10 years, but you're still paying your tax on it. And then not only that, you're paying tax when the tokens come out of the position as well. So let's say those tokens were 50 grand when they went in. A year later, you get them out and they're worth 70 grand. You've got a gain of 20 grand in the time that it's been in the protocol. You've got further capital gains tax to pay. Yes, you've come out of the protocol, you could sell them, but you probably don't want to sell them. You're probably wanting to hodl them. So it's causing unnecessary accelerated tax positions. You still need to think about the reward as well. If you lose beneficial ownership, it might be income, it might be capital. You probably don't want it to be capital at the moment because you then get in the realms of Marin v. Ingalls, which means you actually have to tax an estimate of the future capital reward at the time you go into the DeFi protocol and then reassess when you get the reward in. So the real silver lining with this is, in a bear market, this is a really good way to crystallize losses. So if you want to keep hold of your tokens, you don't want to sell them, don't want to put them into a limited company, if you choose a protocol where you're definitely losing beneficial ownership of your tokens, I mean, there's a risk thing. I'm not giving investment advice. Please don't put your assets with someone where you feel like they might be at risk. But if you can find something where you're losing beneficial ownership, you're creating a tax event, that means you can crystallize a loss if they're currently standing at a much lower value than you paid for them. That's brilliant because you can use that loss now against other gains in the year. If not, you can carry it forward to future years. And yeah, that's the only really silver lining with the whole DeFi debacle.
Sorry, can I just say really quickly, just off the back of that as well, what we see in a bear market is obviously people trying to establish stability. So people will tend to look for things like stable coins. You know, how do we protect against that? Right, let's put that into USDC, for example. But that is not in itself without tax implications, because by putting it into USDC, it's pegged to the US dollar. And obviously, throughout the last year or so, we've seen some quite significant changes between the dollar and the pound. So depending on when you sell out of your stablecoin position, you may well find yourself with a capital gain or a loss. Just to sort of add on to onto that as well.
We're seeing that more and more this year, aren't we?
Absolutely.
Yeah. And people really shocked. But I paid $1, I got $1 back. Yeah.
I was just going to come back on what Louise and Ben were saying. So the biggest crypto tax elephant in the room is this whole issue of beneficial ownership. If you are engaging with DeFi, how do you know that a DeFi protocol has become the new beneficial owner of your assets versus if you retain beneficial ownership? And this is kind of really important in what's happening with the crypto bankruptcies. So with Celsius, a lot of people will have put assets into Celsius at the height of the bull market. So you might have put Bitcoin into Celsius when Bitcoin was almost 60 grand. And if that was a change of beneficial ownership, you could be realizing a huge tax disposal event. And you know, the Celsius bankruptcy is going to wind up at some point, and you're going to get something out of it at the end. And you're probably going to have a loss, but you might not be able to carry that loss back to offset that original gain. So there could be almost like a second kick in the teeth, if you like, as a result of all of these crypto bankruptcies, that you could potentially have quite a high tax charge and a tax problem moving forward. So one of the things we are working on at Crypto UK and with a number of crypto accountants around the UK is how do we really minimize that, and how do we deal with this moving forward? And I think we're going to end up with different situations for different bankruptcies. Celsius, the terms of service said one thing. There was 8 versions of them. FTX, I think they said that when you put assets into FTX, you actually retained ownership rights to them, but there was blatant misappropriation of capital, which kind of go against that. So we're going to see a lot of interesting tax positions come out in the next couple of years, all as a result of these bankruptcies. And the beneficial ownership argument is going to be central to all of that.
Can I take something really quickly?
Really quickly.
Just because we kind of all mentioned it in various ways or forms, what do we do when we don't know the answer to something? We go and Google it, right? Just because there's no HMRC guidance on a subject does not mean that there's no tax implications. HMRC's guidance is their interpretation of existing tax law. That doesn't mean, say, for example, that because there's nothing on let's say, VAT and NFTs, that VAT don't apply to NFTs. There's a lot of understanding required in this space, like you were saying there, in terms of, a DeFi platform being able to have beneficial ownership of assets. What is that protocol doing? Is there rehypothecation of assets? To try and understand these processes. So, sorry, it was just a very quick, if you Google it and you don't find anything, that doesn't mean it's tax-free.
Yeah, I like it. And I think that the takeaway is from this panel is probably buy one of these guys lunch. It's probably cheaper than getting them on board, though. But yeah, I mean, for me, one of the founders of Zebu Live, thank you so much, everyone, for coming. It makes me so proud to see each and every one of you here and all the amazing panelists. So put your hands together for our panelists, and thank you so much.
Thank you very much.
I don't think we have time for questions. I think we're done. So yeah, awesome. Thanks so much.